Good morning, everybody. Today is Tuesday, August 10th. It is the first day of school, so maybe some people are still sobbing. Maybe some are still partying. There's a mimosa or two in your future. I'm here with my partner, Jackie Durham, and today we are joined by Sherri Johnson, our favorite person in the world of TRiM notices and value adjustment board and your local real estate tax assessments. So whenever anybody calls us, which they frequently do because we do income taxes, and they say, hey, help me with my taxes, I always send them your way. So I thought I would skip the middleman this year and bring it to you straight from the horse's mouth. So as always, everyone, as you know, we do record these webinars and they are available for distribution on our YouTube channel, on our KoontzAssociates.com and KoontzParkin.com websites, and also on our Facebook pages. So if this is so riveting that you want to do it again, or share it with someone who couldn't be here, you'll be able to catch it there. So without further ado, we are joined by Sherri Johnson. Thank you so much for coming on with us today.
Very welcome.
We wanted to hear what you've got to say. It's about that time. Anytime August comes, I'm sure you don't get to go on vacation.
It's a bad time for sure. I think it's like April for you, pretty much.
Yeah, right. I think that's true.
It is that time. TRiM notices are going to be coming out in a few weeks in most counties. I don't know how many people know what a TRiM notice is, but we're going to talk today about what they are, how to read and understand these things, and what's important about them, why you shouldn't throw them in the trash can and ignore them. So first of all, start with, what is a TRiM notice? We call it a TRiM notice. The title of it also goes by Notice of Proposed Property Taxes, but we use the term TRiM notice in the industry here, which is short for truth in millage. And it's mailed by the county property appraisers, usually in mid to late August. Because it's mailed by the county property appraisers, every county's notices go out at a different time. But it is important, as we're going to talk about, there's some very important deadlines that depend on when that TRiM notice is sent out. So it's very important to be on the lookout for them. The truth in millage notice, essentially the act was passed in 1980. And the stated purpose of it was to inform taxpayers which government entities are responsible for the taxes levied and the amount owed to each taxing authority. That's the stated purpose. In reality, it's all about blame. You know, you have these public officials that got tired of being, just blamed for taxes that they had nothing to do with. You had school boards who, wanted the public to know that half of the school board tax is actually required by the state. And, you had county commissioners who wanted people to know, look, the school board has taxes too. So, and the property appraiser, of course, wants everybody to know that they don't have anything whatsoever to do with tax rates. All they do is value your property. So the real purpose was to let people know who to call when they're unhappy, I would say.
That's hilarious. I didn't know
that. So, here's what you're looking out for in the mail. It's a sample TRiM notice. I don't know if this was the best example, but I just pulled one from my files for someone who contacted me a while ago and redacted it. This is from 2016. It's a really small property, but this at least gives you an idea of what it looks like. This is the thing you get that says, do not pay, it's not a bill, because the bills don't come out till November. So this isn't a tax bill. It's just a notice that lets you know all the components of what makes up your taxes so that you know who to complain to, basically. Let's put it that way. But let's back up. Before we get to talking about what's in the TRiM notice, let's talk about how property taxes are determined. Your property tax is going to be made up of two components each year: the taxable value of your property and the tax rate. And so essentially, if let's say your tax rate is 15.7880, which is what it was in this sample TRiM notice, and you have, just for round numbers, a taxable value of $100,000, then basically your taxes are determined by taking $100,000, multiplying it by 0.015780, and that results in your taxes. The reason we don't multiply it by 15.788 is because tax rates are what we call millage rates, which means that they represent the taxes you pay on every $1,000 of value. So got to move those decimal points two parts. So property taxes, like I said, they're made up of two components: the taxable value and the tax rate. And the TRiM notice is intended to show you both of those components so that you know how your taxes are calculated and what you need to do if you disagree with them. So let's start with the tax rate. How is the tax rate determined? You can see on this sample, I don't know if you, can you see my cursor when I move it?
Yep.
Okay, so you can see on this sample one where the tax rate is. Right here, it says if your tax rate and taxes this year, if proposed. So these represent the tax rates that are being proposed by each of the taxing authorities that apply to you. For most people, the largest amount is going to be the school tax. The largest here is the one imposed by the state. And then you have the one by the local school board. The next highest one's usually going to be your county taxes. And but you're also going to have all these other little ones like the hospital board and the mosquito board and all these other things. And sometimes if you're in a municipality, like this person is, you're also going to have taxes imposed by the city. So this person here happens to be in the city of Northport, so they get an extra 3.5 millage rate. And the total rate is determined, of course, by adding all of these together. So that's the first component of your taxes that you need to pay attention to. And on the TRiM notice, it'll show you what the prior year's TRiM notice was and what the proposed tax rate is going to be, which is the thing you need to pay attention to. All right, so the second component of your taxes is taxable value. Now, it's important to note that when we talk about taxable value, this is not the fair market value of your property. It's generally going to be lower. If you've had a homestead exemption for many years, it's going to be a lot lower, most likely. So taxable value, the taxable value of property is going to be shown in this red column right here. And I'm going to explain in a minute why we have two different numbers. But basically, the taxable value, in order to get there, you have to start with fair market value. And then you calculate assessed value, which is where you apply any caps. For example, if you have a homestead exemption, you'd be entitled to the 3% Save Our Homes cap. If you don't have a homestead exemption or it's commercial property, there's a 10% cap on assessment increases. So you apply those caps and then you subtract any exemptions, such as most common one, the homestead exemption. And after you do all that, that's how you come up with your taxable value. And the reason that there's two different taxable values noted here is because some of these tax benefits that I mentioned, some of these exemptions and caps don't apply to school board taxes. For example, the 10% cap that applies for non-homestead property applies to everything but school board taxes. And also the second homestead exemption, as we call it, only applies to non-school taxes. So that's why we have two different numbers there to make it super hard for me to calculate people's taxes. All right, so taking that piece by piece, we mentioned there's three different values to deal with. You know, there's market value, there's assessed value. Oops. Oh no, what did I do? Okay, let's go back, sorry. That's what I get for clicking ahead. There we go. Okay, I'm just going to leave it. Oh, wait, started from current slide. Okay. Okay, so like I said, there's three different kinds of value, which can be a little confusing for people. The easiest one to understand is market value. Sometimes it's referred to, if you go to the property appraiser's website, sometimes they refer to it as just value. It's the same thing. Just value and market value are the same thing. And that's noted right here. And this is going to be the actual fair market value of your property as determined by the property appraiser. A couple things to note about this value. It's determined as of January 1st. So when you get your tax notice in a few weeks, it's not going to represent their estimate of the value right now. It's going to represent the estimate of the value of your property as of January 1st, 2021. And usually they calculate these values based on sales of similar properties during the prior calendar year. So if you sold your property in the last couple months, that's probably not going to have much, well, it's not going to have any impact on the just value that you see on your tax notice. If, you know, for example, you had a recent sale and you think, oh my God, this value is way off, you probably want to wait till next year to question it, because next year's taxes will reflect the sales from this year. Another thing is, although some people might disagree with me on this, particularly with residential properties, usually the fair market value is going to be on the low side. This is not going to be the value you see on Zillow or any of those places. It's generally going to be pretty conservative. Part of that is because when the property appraiser assesses the value of your property, they are required to make a deduction for costs of sale and purchase, which is intended to reflect the costs that you would incur for real estate commissions and that closing costs if you were to sell the property. Across the board, they generally deduct 15% for cost of sale. So typically, the value they come up with is going to represent more like 85% of the fair market value. And it may even be less. I say that most of them are going to be on the low side. Usually when I have people come to me with value disputes, it's usually commercial property, because those are a little bit more questionable, harder to assess. With residential property, usually the ones that I see that are high tend to be unusual properties. Either they're very unique waterfront properties, there's a lot of land or acreage, or there's something unique about the property that makes it a little bit difficult to assess. But for your typical house in a neighborhood, usually they're going to be pretty reasonable. But it's important to know, if you do decide to challenge your property taxes, this is the value you're going to be challenging. So we'll get to that in a little bit. But if you were going to challenge your property taxes and you were this person, you'd have to show that the value of your property as of January 1st is less than that 123,600, which I know is really low a few years ago. All right, so the next value we're going to talk about is assessed value. And that's these two numbers right here. And assessed value is when the property appraiser takes the fair market value, and again, they adjust it for any caps that you're entitled to. I mentioned the 3% homestead cap earlier. For those of you who don't know what that is, when you get a homestead exemption in Florida, the value in the homestead exemption is not the $25,000 part, it's the cap, what we call the Save Our Homes cap, which means that after you receive your homestead exemption and until you lose it, no matter how much your property actually increases in value, the taxable value cannot increase by more than 3% per year, or the percent change in the consumer price index. And for that reason, even though your value may have skyrocketed over the last 10 years, if you have a homestead exemption, you're probably taxed at a much lower rate. And also, of course, we have portability. So when you move within the state of Florida from one home to another, I won't get into the details of that because it can be complicated, but as long as they're close in time, a lot of times you can qualify to actually take your tax cap savings to the new property. So those tax cap savings can build up a lot over time. And in this case, you can see this is a person who actually came to me because they lost their homestead exemption in this year. So you can see the previous year, their market value of their property was $109,000, but the assessed value was only $77,000. That's because they had the homestead exemption and the Save Our Homes cap. And then this year, they lost their homestead exemption. So this year, the assessed value is the same, except for the non-school taxes, because they got this other alternative 10% cap. If you have property that's not homestead, it's still capped at 10%. So that's why you have those numbers the way they are. The other adjustment that you can see doesn't apply to most people, but we do have an agricultural property classification in Florida. So if you qualify for the agricultural classification, your property can only be assessed at the value that it would be assessed at, or the value you would get if it were sold for agricultural purposes. That's why you see a lot of cows around here and all these nice big developable vacant lands. Essentially, in order to get the agricultural classification, you have to have a commercial agricultural operation on the property. So usually developers lease their land to ranchers, and there they go, they get that agricultural classification. So, all right. Now, here's the question I get a lot from people. They want to know, they're looking at fairness. They want to know why their neighbor's property is valued at so much less. And 9 times out of 10, the reason they're seeing that is because they're looking at the wrong value. Instead of fair market value, they're looking at assessed value. And you have to remember that because of the homestead exemption, assessed value is an artificial number. Assessed value reflects the Save Our Homes cap. You've been receiving a homestead exemption for many years, and the value of your property has been skyrocketing. That Save Our Homes cap is keeping the assessed value down. So if you're looking at your neighbor's property and yours, and you're looking at the assessed value or the taxable value, that's not a valid comparison. It's apples to oranges. If you want to actually compare and see if you're being fairly assessed, you need to focus on the market value of the property. All right.
Sherri, do you ever notice people, I guess I feel like I get this question quite a bit, where they say, hey, I see that the just value, the fair market value is going down, but my assessed value continues to tick up. And I think they forget that it can continue to tick up as long as it doesn't exceed that just value. And I think that throws a lot of people for a loop too.
Yes, that's absolutely true. I think we're going to see that, possibly like next year, because this year we're seeing values going up. Next year, maybe the values will dip down. But what happens is, so let's say you're this person, and okay, so let's say last year their property is assessed at 109, and then this year their property is assessed at 123, and let's pretend they still do have the homestead exemption. Their assessed value is going to be calculated by taking the prior year 77,831 and adding 3% or the percent change in the consumer price index. So if they have a homestead, like I said, their assessed value the next year is actually going to go up, even if their just value goes down, because it can keep going. As long as it doesn't exceed just value, it can keep going up by that 3%. Good question. All right, so that brings us back to the taxable value. So essentially, taxable value, we take that assessed value, which reflects the caps, and we subtract all of the exemptions that you are entitled to. The most common exemption in Florida is the homestead exemption, which is $25,000. We also have an additional homestead exemption that's $25,000 off the value over $50,000. So if your house were only worth $50,000, you wouldn't get that second exemption, but if it is, you would. And that's one of those exemptions that only applies to non-school board taxes. And those are the exemptions most people are going to be looking at. Oh shoot, I did it again. I did. Oh no, here we go. Okay. Those are the exemptions most people are going to be looking out for. There are other exemptions that I deal with in my practice that aren't as common. Government property is generally completely exempt. Educational property, religious property, charitable use exemptions. There are all kinds of exemptions that I deal with in my practice, but for most people, it's going to be the homestead exemption. And it is important when you get your TRiM notice to make sure these exemptions are reflected on the TRiM notice. And they're going to be down here at the bottom. Show my cursor. And again, you can see that this person in the prior year received both the regular homestead exemption and the additional homestead exemption. But this year there's a 0 there. Typically, if the property appraiser removes an exemption from your property, you're going to get a notice about that. And there's going to be a deadline to challenge it running from the time you get the notice. And usually those notices are going to go out in June or July. However, the irony is sometimes when the property appraiser denies or removes a homestead exemption, maybe it's because they think you're no longer living there. So they send the denial letter to where they think you are living up north somewhere. So you don't get that notice. I see that a lot. So that's why it is important to look at these TRiM notices, because if for some reason you didn't get the notice of denial, this is your last chance to catch this error and possibly challenge it. You cannot, we're going to talk about tax challenges later. You cannot challenge prior year's denials. You have to challenge the current year only. So again, this is your last chance to catch that error. So pay attention to your TRiM notices when they come in. And if you don't get one, be sure and look it up online, if nothing else, just to make sure that you got all the exemptions that you're entitled to. All right, so now how do we challenge taxes? Again, there's two components of your tax bill, the tax rates and the value, the taxable value. The first part, the tax rate, that's the part most people tend to overlook. But obviously a tax rate is determined by local government entities. And if you don't like it, they do have public hearings where you can come out and voice your opinions. And these are going to be listed on the second page of the TRiM notice. You're going to have the dates and times of all those meetings. So if you want to express your pleasure or displeasure, you may. And obviously, if you don't like it, you can vote them out. Going to editorialize a little bit here.
Where do we express the pleasure? I don't get those calls.
Never go. So, my editorial comments are this. You're going to see this a lot this year. You'll see government officials say, oh, we're not increasing your tax rates this year, because they want to look very responsible and everything. But bear in mind, there's two components to your taxes. It's the tax rate and the taxable value. When tax values go up, if they keep your tax rate the same, they are increasing taxes, okay? I see that, in years like this, when taxable values go up, it's a windfall to the government because they can say, well, we're not going to increase your taxes this year. And that's not true. If they're keeping the tax rates the same and values are going up, your taxes are going up. Sometimes they will even say, oh, we're going to decrease your tax rates this year, pat me on the back. But again, you're like this, if values are going up significantly, even if they decrease the tax rate, your taxes may still go up. So just call them out on that, huh? Pay attention. All right, so the other component of challenging your taxes is to challenge the value of your property. And to challenge the value, and I'll get into a little more detail on this, you have two options. You can either file a petition with the County Value Adjustment Board. And if you choose to do that, there is a strict deadline. It's noted down here in red. This was for 2016. So it was September 16th that year. TRiM notices haven't gone out yet this year, so I don't know what the deadline is going to be, but it's usually in mid-September. So if you choose to file a petition with the Value Adjustment Board, that date is critical. You need to do it by then. If you're on the fence and you're not sure whether you want to challenge it, property appraisers will hate me for saying this, but it only costs $15 to file a VAB petition. So if you're on the fence, you can do it electronically. It's very simple, and at least then you can decide later to withdraw it, but at least you're protected.
When are those hearings typically? How long after you submit the challenge?
Sure. It's different for every county. Last year was really off, but historically, I would say exemption hearings are usually held in late fall. And valuation hearings can go into the winter, like into February, March. Again, it's different for every county. I'm assuming most of your participants are from our local area, Sarasota, Manatee. And in Sarasota, Manatee, typically the hearings are wrapped up by like March, I would say at the latest. In other counties, practicing like Broward and Miami-Dade, you can have a hearing 2 years after you filed the petition, which craziness. So, but here you're usually looking at a couple months out. And we'll talk a little bit more about what's involved in the VAB petition.
Yeah.
The other alternative is you can go directly to circuit court. If you decide to file a circuit court case, the deadline is 60 days after the certification of the tax roll. The tax roll is usually certified in October. And so the deadline for filing circuit court cases is usually going to be early to mid-December. Obviously, if you're just challenging the value on your house, you probably don't want to take it to circuit court. we'll talk a little bit more about, what cases, typically will go to court. But usually these are going to be cases with commercial property or people that have been long-term disputes with the property appraiser and they know they're not going to, get anywhere with the VAB. Or there's also some things that the VAB can't address. So, all right. So you want to challenge the value of your property. Okay. I had to put in the little joke about how you look at your house versus how the tax assessor looks at your house. Again, not typical. Usually their values are pretty conservative, but there's a lot of reasons why you might want to challenge the value. Some people even want a higher value, perhaps because of portability. Maybe they know they're going to be selling their house and moving to a new one, and they want to enhance that Save Our Homes tax savings. In that case, it's not very common, but I've had people who want a higher value. And not very common. Most people want to reduce it. And if you want to, oh, sorry, let me back up here. Okay, I don't know why I keep.
You're fired from PowerPoint. Do not call Sherri for more tips.
Okay, well, I just want to remind you. So if you are slideshow. A good slide. Okay. Gotta stop playing with that cursor. So if you are challenging your value, again, I addressed this before, but remember the key date is January 1st. So you're challenging the value as of January 1st. You want to show that the value they've listed on your tax bill is higher than it should have been as of January 1st, generally based on sales that occurred during the prior tax year. So how can you do that? The most simple way, and the way that I generally recommend for people who are just challenging the value on a residential property, is the value adjustment board, because this is intended theoretically to be people friendly, so that ideally you don't need a lawyer for it, although you can. The value adjustment board is made up of 3 county commissioners and 2 school board members. However, the actual hearings regarding the value of the property are conducted by appraisers that are hired as special masters by that board. And generally, the VAB accepts the recommendation of the appraisers. One thing to note, the appraisers are not hired by the property appraiser. Some people think that they're all in cahoots and everything, but they really aren't. They're totally separate. So some obviously might be more friendly to government, and some might be less, but they are independent appraisers that are going to hear your petition. If you go this route, you can represent yourself. You don't need an attorney and appraiser. Obviously, your chances probably get better if you do have help. But again, it's meant to be cost effective, hence the $15 filing fee and the more streamlined, quick approach. Now, the value adjustment board, besides hearing value disputes, they can also hear petitions regarding the denials of exemptions and classifications. But something to note is if you receive a denial of an exemption, the deadline to file is a lot earlier. So that's why I mentioned that if you are denied an exemption, usually the property appraiser sends a notice of denial. They're required to send a notice by July 1st. The deadline to file a VAB petition is then 30 days from the day they send that denial. So if they remove a homestead exemption or an agricultural classification from your property, your deadline to file a VAB petition is going to actually be early in the summer. And oftentimes it's actually before the clerk even has the online petition system up and running. I had to hand deliver one the other day because they don't have it up and running yet. So again, pay attention to your TRiM notice, because if you didn't receive that notice of denial, at least you can go ahead and file a late VAB petition. And there is a procedure for getting late petitions through and arguing that you have good cause for filing late. But ideally, if you're denied an exemption, you should have filed earlier in the summer. One thing they cannot hear is challenges to tax liens or prior year's valuations. A large portion of my tax practice involves helping people who've received tax liens on their property due to the property appraiser contending that they were improperly receiving a homestead exemption in prior tax years. If you have a tax lien placed on your property, the VAB cannot do anything for you. That's a situation where we would have to take it to circuit court if we couldn't resolve it with the property appraiser. The other thing is, as I mentioned before, they cannot hear prior year's valuations. That's why these deadlines are so important, because if you go in the VAB this year and try to say that the value was wrong last year and the year before, and you've been overtaxed for the last 10 years, that's not going to work. You can't do that. You can only challenge this tax year. Now, let's say you go to the Value Adjustment Board and you have your hearing and they rule against you. You can still take it to circuit court. If you decide to do that, then you have to file your court case within 60 days of receiving the VAB's decision. Again, I don't really recommend that in most residential cases, but if it's a larger property, waterfront property on KCK, the taxes are really large, or commercial property or multifamily property, maybe it might be worth it. So in that case, you do have the option to take it to circuit court. If you do that, you're starting from scratch, just so you know. It's not a matter of you're going to court to argue over how the VAB hearing was conducted. So if you're unhappy with how the special magistrate treated you, or any procedural issues or anything like that, that's not going to be heard in circuit court. In circuit court, you're going to be starting from scratch and just arguing over the value of the property. If you have concerns about the procedures or how you were treated, you probably want to contact the Department of Revenue or the VAB's attorney, but there's no remedy in circuit court, really. All right, so court. If you decide to go to circuit court, either after VAB or without, again, the deadline is usually going to be early December, or if you lose at VAB, you have 60 days. Circuit court, you really need an attorney. Obviously, if you're an individual, you have the right to represent yourself. I don't think I've ever heard of anybody winning. Okay, so if you decide to go that route, you probably want to get counsel. If you have a dispute over the value of your property, you probably want to get an independent appraiser as well. You don't have to, you're not required. Arguably, I could go in there and pick apart the property appraiser's appraisal and might be able to win that way, but it's certainly your chances of success are better if you invest in an appraiser. Now court, they have a lot more leeway. They can hear disputes regarding value, exemptions, portability, and they can also hear challenges to tax liens. So that's where I spend most of my time. But just like VAB, they cannot hear prior year's taxes. So can't emphasize that enough. If you got an issue with your taxes, you got to deal with it now. Do not wait, because if you wait, you won't be able to do anything about them. So, all right, I think that was about it.
And people are fond of waiting.
They like to wait.
Like, when there's a problem, one way to make the problem not better is to wait. On the income tax side, they can get away with it a little bit because we have a lot of options, but I can't say it enough here that the bell rings and you're done. So don't sleep on that TRiM notice.
There's nothing more painful as an attorney than when someone calls me and they have a really good case. They have something, they've got an interesting issue, or it's obvious that for the last 10 years, they've been overpaying, but I can't do anything about it. And it sucks. You can't, it's not even a matter of, people ask, well, can you call the property appraiser and just try to work it? No, can't do nothing. So yeah, gotta go.
Get on it. One other thing that's not necessarily a VAB issue, but that while we're on this subject of valuations that I wanted to throw out there that I see regularly is if you are buying, especially in this market, from someone who built the house. So like, for example, I bought a home built by a builder, and in the next year, I sell that home to Jackie. You may run into this timing situation where there hasn't been an opportunity for there to be a new assessment from when it was still assessed as vacant land in the prior year. So when I do prorations on the closing statement, I'm using that old really low number from before there was a house on it. And that doesn't go well when the second buyer gets their TRiM notice or their tax bill come November, because the prorations, the values, I'm not suggesting are improper at all. But that buyer was given a tiny credit for proration of the most recently available tax bill. So, you know, if you're closing on this house in October, I won't know what the new assessment is. So I can't, and we don't prorate on the TRiM notice, we prorate on the bill. So that just is something to keep your heads up about. You might want to make provisions for that in your contract.
Homesteads, with sometimes people base their, you know, they look at the taxes the prior owner was paying, but again, that prior owner has been getting homestead exemption for 20 years. So the taxes that the new owner pays are going to have nothing to do with that.
Yeah, we've got to be really careful about that. We did get several questions on portability. Can you talk a little bit about that? Most recently, this person says, I tore down my home and am building a new one on the same lot. It was demolished in December of 2020 and the homestead exemption removed. With delays now, we may not be complete until 2022. Will I still be able to port back the value with the delay?
Okay, so essentially the portability, the key is you have to have received a homestead exemption within the prior 2 tax years. So for example, let's say you're applying for a homestead exemption on your new property in 2022. Is that, well, she said it might go in. Okay, so this person, it sounds like their new house is going to be completed in 2022, which would mean they would be applying for a new homestead exemption in 2023. So they get their new homestead exemption 2023. In order to get portability, they would have to have had a homestead exemption on their previous residence in 2021. So no, the portability would not be possible there. And that's where, like I said, it's complicated because, you know, people say, well, you can port in 2 years, but it's 2 tax years. So that's the key is if you're getting the new homestead exemption January 1st, 2023, you can only port an exemption you've received in the last 2 tax years. So 2021, 2022, yes, I think then you should be all right. If you, sorry, looking at the question, she asked if they finished by December 31st. If you qualified for a homestead exemption on January 1st, 2022, meaning you lived there, that would be key. Might be cutting a little close, but if you lived there and qualified on January 1st, 2022, and you received a homestead exemption on your prior property in 2020, then yes, you'd be able to port that. So
I mean, your contractor can keep up with the schedule.
That's right. Yeah, so, I saw it.
On the new construction vein, the opposite shoe we want to address too. So what if my house is basically done and I tell my contractor, like, hey, just don't go get the CO until January 3rd because I'd like another year of that really low tax bill because the house is basically done.
That's a tough call because you might be getting some tax savings for 1 year, but you don't know what the market's going to do. And remember, with your homestead exemption, that cap kicks in the year after you first homestead. So, you know, it's really hard to predict what the market's going to do. But if you end up homesteading, you know, at the wrong time, you might regret it because you might miss out on a lot of tax savings by delaying a year. You know, like I said, timing is kind of everything. If you know, value, let's say you get your homestead exemption in 2021, you know, and then the market goes up significantly. So 2022, you're going to have a lot of tax savings. If you had decided, well, I'm going to wait, you know, and not get the homestead exemption until 2022, you know, you might end up be sorry in the long run.
Well, maybe not even just the homestead exemption, but I've seen people trying to not go get the CO. But if it's substantially complete, the property appraiser is going to be able to overstep that and say,
yes, CO is not dispositive. I mean, it's good evidence, but it's not necessarily dispositive because it's substantially complete. So if they don't live in it,
it may not work for you. I think people just have a perception that that's some magic bullet that I have seen mixed success with.
Right.
And you see all the crazy miss successes. One case that I recently sent over to Sherri is another good example of how things go wrong. We had a mutual client that was married, was single when he lived in the house. He had the homestead exemption. He then got married. His new wife, unbeknownst to either of them, didn't realize that she still had a homestead up north. And they got a nice ugly letter. I immediately called Sherri, and Sherri had the bad news to be like, sorry, she's claimed homestead in 2 places. So we tried to backdoor and relinquish the homestead up north, and the big bill was, albeit a shock and maybe even arguably unfair, still technically violated the rules of the homestead exemption. So that payback was due for several years, and that was ugly.
A lot of the homestead lien cases that I get come about because of these dual homestead exemptions, we call them. And I shouldn't even say dual homestead exemptions, because in a lot of the cases, a lot of the people that contact me, the exemption they're getting in the other state is not even a homestead exemption.
Mm-hmm.
A lot of times it's the New York Star exemption, or it might be, a lot of these other states have really chintzy exemptions. I mean, it might be a $25 exemption, but under Florida law, if you're receiving the benefit of any residency-based tax credit in another state, you can't have a Florida homestead exemption. And they also look at it as a family, from the family unit perspective. So if one spouse is getting a homestead here and the other spouse is getting a star exemption in New York, that can be a problem. There are, certainly some arguments that are still out there that we can raise. If I can show that the exemption is not residency based. Mm-hmm. Sometimes they're not. Sometimes their laws are very different. We might have something there, but those are tough. Usually most homestead lien cases come about either because of dual homestead exemptions. Sometimes I get, people who were renting and a neighbor routed them out or something. And the other is inherited property. Sometimes the person who is getting the homestead exemption passes away. Mm-hmm. And maybe adult children just keep living there and claim the homestead exemption. You can't do that. The homestead exemption is not inheritable. No matter what you do, you can't pass those benefits on. You have to start fresh when the person dies. So.
Can you talk a little bit about, because you said renting, about the impact if you are trying to Airbnb a part of your primary residence out, and what that will do for homestead exemption?
Yeah, well, that's interesting. So I actually have a case pending before the Supreme Court right now on that very issue, or similar to that issue. So yeah, a lot of the property appraisers now have been aggressive in going after people who are renting out rooms or parts of their property. I recently had a case that went to the 2nd District Court of Appeal where we were successful. In that case, my client had a 4-bedroom house, and he rented out the 2 bedrooms upstairs, and the property appraiser imposed a tax lien saying that the portion that he rented out was not homestead. Fortunately, in our district, the court agreed with our position and said that that it's as long as it's a single family residence, that it's your homestead exemption, even if you have a roommate or family member or some other business use of the property. That they did, however, appeal that to the Supreme Court, and we're waiting to hear whether the Supreme Court is going to hear it. So, and I know in other counties, they're not following that case. They're still doing what they want to do. So that's something to be aware of, because the property appraisers are aggressively going after that. From a legal standpoint, I disagree with it. I don't think that's proper. One other aspect of that is, people who have like a mother-in-law suite on their property. Mm-hmm. That's a harder case. I have one of those right now, and probably not going to take that any further, because that's a harder case to make when you have a separate building on the property, whether it's a garage or mother-in-law suite. If you're renting that out, that's probably not going to be considered homestead, and I probably won't win.
Hey, you can't win if you don't play, right? Just like the lottery.
Well, you see a lot of people doing that nowadays they have larger lots, and they want to make a little extra income, and they throw, a mother-in-law suite back there, or people are even getting into these container homes that are, they're pimping out these container homes and Airbnb those. And I've actually had someone recently come to me and ask me, particularly about that situation. It was detached from the home, had plumbing running to it and everything. And that's kind of the answer I had to give them. Like, I wouldn't count on that being under your homestead exemption.
Probably good advice.
I don't know what I would fit in a container home, but I don't think I'm a candidate for that.
You're into the tiny house movement.
No, I'm out. We do have a lot of real estate agents and buyers that we work with, and oftentimes people do ask if they can use a formula to plus their purchase price to kind of guesstimate where their taxes might land. Is there any kind of ballpark-ish? Like, if I said, hey, capital gains, just use the max 20%, like, I have some of those kind of tools. They're not spot on, but some ballparking tools in the income tax world. And I don't know if there's anything like that in your world.
Well, I mean, typically, like I said, the property appraiser, how they do it, they look at all sales of similar properties, including the sale of the subject, if there was one in the prior year, and they take off 15% of each of those sales. So, I mean, a ballpark, if you know that this property in question sold in the prior tax year. So, you know, if you have a property that sold in October 2020, the 2021 tax bill is probably going to be pretty close to 85% of that purchase price, most likely. You know, it's not exact because they don't look solely at that sale price. They look at the whole neighborhood, but usually it's going to be pretty close to 85%.
Okay. Perfect. That's all I have for questions. I really
have one more question. Just jumping back to the portability. You mentioned that, you know, I believe the portability credit, if you will, that you can take from your existing homestead and port to your new homestead is the difference between the just value and the assessed value at your existing homestead.
Correct.
And you mentioned that some people seek to. Okay, right. I'm oversimplifying it, but based on that, I know you mentioned
that's new territory for Jackie.
So you mentioned that some people want to increase or find ways to increase their just value. And I feel like I've heard some folks talk about that with respect to, hey, I did some renovations. It didn't increase my footprint of the property by more than 1,500 feet, but it did increase, you know, arguably the value in some substantial manner. Is that one case where you would recommend that they maybe try to increase the just value so that, you know, I don't think that would in effect increase the assessed value because of the 1,500 square foot cap. But I was just curious about that because I've come across that question as well. And that if that's accurate, that could be a way to increase your portability and give you some tax savings on the back end when you sell and relocate.
Right. I know. I see what you're saying. As long as it's not going to affect the ultimate taxes you pay, because, for example, you have the homestead exemption, and so you have that cap, then yeah, there could be some benefit to getting the just value increase. So that way, as long as you have the homestead exemption, your taxes don't increase. But when you sell the property, you know, arguably you'd be able to port more tax savings with you to the next property. And, you know, that's what I also tell people too, when challenging their taxes, you sometimes it doesn't make sense to argue for a lower value because, you know, that is going on the record as the, you know, if you're looking at selling the property in the future, I don't know, do you really want the public record, you know, that your property is only worth this much? You know, it's a double-edged sword. Sometimes I have commercial, I got one right now, you know, commercial property owner. And we had that discussion, you know, whether it makes sense to, you know, make certain arguments regarding why his property is worthless, you know, if he wants to maybe sell that property in the future, you know, because these things, all these things that you say about the value of your property are now public record, and issues with your property, maybe you don't want that to be in the public record.
Right.
That's a really good perspective there. Oh boy. All right. Well, I just wanted to once again say thank you. This has been incredibly helpful, and tax isn't always everyone's favorite topic, but as you can see, there's always a ton of questions. So it must be on everyone's mind. So thank you so much for your time. If anybody has questions, you're welcome to reach out to Sherri. She can help assess your case and see if this is valuable. She's done it loads of times for our clients and is very quick to determine if this is worth running down or something that you should just complain about over a glass of wine.
I couldn't say that myself.
Speaking of wine, you can join us next week. We'll be on with John Cipher, and we're going to be diving deeper into financial statements. So next week, we're going to be looking at your income statement. And while those tell you what you spent money on, they don't necessarily help you with why you spent it. So he's got some hacks on things you can do with your chart of accounts so that your CPA is happy and your coach is happy, so that you can really make some good business decisions. So thanks so much for your time, Sherri. If you, we hope you guys have a great week. We'll see you next Tuesday.
All right. Bye, everyone.
Bye.